Welcome to Live the Dream with yours truly, Marty Kaiser. Buckle up and let's get started. Happy Friday, everyone. This is Marty Kaiser with Greater Orlando Realty with our new episode of Real Estate Tidbits podcast. Hope all is well. Today, we're going to have an emphasis on a lot of data and some conversation about interpretation. The first thing I wanted to mention is what is the actual state of the real estate economy? Well, you hear a lot of mixed information about that. If you're a student of real estate and read up on it and experience market trends and changes, there's a lot of different forecasts. So how do you know who's got the most accurate information? Well, truthfully, you really don't. A lot of people have an opinion. There's an old saying, everyone has an opinion. They use the term of your posterior for that. So you kind of have to cipher through what is being opined. What are they basing those opinions on? What type of facts and data are they referencing? What type of trend analysis are they speaking about? And then making an informed decision. At least for me and how I'm counseling my customers right now, I try to give them my insight into my experience. I've lived through a bunch of different real estate cycles, both up and down. And of course, my assessment of the current market, where I see it at currently and where I see it going in the short term. The short term for a lot of my customers is probably the next 3 to 9 months, what's going to happen during the balance of 2025. So I always say kind of, whose analytics do you use? Well, that's an interesting question. Now, for example, for this podcast, I did my own research beyond my opinions. And I'm going to paraphrase and quote two national organizations. One is well known in the real estate business, and one is well known in the business sector. The one in the real estate business is Zillow. I'm sure most people have heard of Zillow. They're a real estate database with a lot of different tentacles. They're the friend and foe of realtors because when I say foe, what do? They actually resell data that the real estate agents have put forth and try to sell it back to the agents to generate leads for them. So we're paying for our own data. So that's kind of unusual, I would say, not a particularly good business practice if you were in other industries. But Zillow has done a great job of branding themselves. They're an easy site for the average consumer to go in and look at. And so if you ask the consumer about real estate information, probably Zillow is going to be the first or second place they look at. And so because they have such notoriety and following, I wanted to share a few insights that they've recently come up with. So a lot of these are probably similar to things you've heard with me, but not necessarily exactly the same. So basically, I'll just kind of read a couple lines of their latest forecast. They predict soft growth for home values and existing home sales in 2025. They expect mortgage rates to decrease slightly in the near term, meaning in the next 30 to 60 days, and remain relatively flat for the remainder of the year. So right now, depending on the day of the week and whose mortgage rates you're reading, they're probably in the neighborhood, give or take, of around 6.5% to 7%, just to give you a frame of reference. According to Zillow, they expect home values, now this is a national statistic, to increase 0.6% this year. So what does that mean? That means it's approximately half of 1%. So to pull out some easy math, if you were using that formula on a $500,000 house, That means that they expect the average value of that $500,000 house to go up approximately $3,000. 1% of 500,000 is $5,000, so 0.06% of that equates to 3%. So obviously not a very large increase on a national basis. They've recently downgraded that because a few months ago they thought it was going to be at 0.9%. So 0.9% would have been $4,500. So they've decreased on a $500,000 sale projection-wise from $4,500 to $3,000. They feel that these changes are caused by a couple of things. Number one, the rise in listings nationally, which is fueling softer price growth. As a basic economic principle is greater supply provides more options and more buying power. In this case, you're talking about buyers. Existing home sales in terms of the transaction volume are expected to increase by 1.1%. So again, if you use that on a relative basis, let's say in a particular county, we'll use Orange County in Florida since that's the primary county that we talk about. Let's just say that Orange County, and I don't know this statistic, I'm just using this for math. Let's say they would have 10,000 transactions during the 2025 calendar year. A 1% increase on that would be approximately, so if 10% of 10,000 is 1,000, so 1% of 10,000 is 100 transactions. So in essence, 1% is not very significant. They expect, as we normally expect, a temporary boost in sales during the spring. So that's why we always counsel people when they say, what's the best time to put a house for sale? We tell them the spring and summer, meaning late March to around mid-June are the best months to put a property for sale. And then they expect that to be followed by a seasonal slowdown. However, with little relief expected for mortgage rates, existing home sales are likely to remain below pre-pandemic levels, which the pandemic was defined as coming out in March or April of 2020. So basically, 5 years ago, our transactions now are expected to be less than them at this point. And until mortgage rates decrease to improve housing affordability, they expect downward pressure on home sales to continue to persist. So I really don't have any large disagreements with Zillow. I feel they're pretty much on point for that type of analysis. And that's similar to what I've told people. That being said, I've come to the conclusion that people really have to make a decision when it comes to their own real estate based on their particulars in their lifestyle. In other words, what are the reasons they're considering selling or buying? So I think those need to be the priority as opposed to speculating on where the real estate market and economy is going. I think for the most part, there's not going to be, hopefully, any dramatic change downward. So it just you have to look at what makes sense for me. What are the reasons why I'm contemplating buying or selling? If those reasons are important, then you need to go forward with your plans and just strategize accordingly. For example, are you relocating for job purposes? Are you selling because you're an empty nester and don't need all the size or square footage of a property? Are you buying because you're tired of paying huge rent and having nothing to show for it, and you're not getting tax deductions, you're not building equity? Are you possibly selling to move to a different part of the country because there's some reason, whether you're tired of Florida, or you want to go to a lower cost of living area, or maybe you want to move nearer to family? I know a lot of my customers the last couple of years, especially the market where the consumers are over 50 years of age, they're moving to be nearer to family. They want to be, sometimes they have elderly parents that they need to help out with. Other times they want to be near their children so they can get more of a relationship with their grandchildren. So there's different reasons, but there's definitely a big trend in that direction. So those are a couple of things that Zillow has come up with. The other data source, who goes a little bit more into depth than Zillow, and I've put a lot of stock in their business acumen and their data that they use, is Forbes Business Magazine. And so some of the things that they talk about right now are that the housing market remains challenging, with the prices being much higher than they used to be. However, when you combine higher prices with the higher mortgage rates, this has created challenges for buyers. You know, the mortgage rates, obviously, for a few years ago, they were down to 2.5% or 3%, you know, and now they're close to 7% right now. And this is in most parts of the country. And obviously, per Forbes, the combinations of these two factors has eliminated the price surge that we had in 2020, and they've lost considerable steam over the past year. And even in some softer markets, prices have even declined thanks to increasing inventory and softer demand. And experts through Forbes expect this deceleration to continue in 2025. Fortunately for us, the prices in the Central Florida area have held their own, and they've slightly increased. And I expect that trend to continue. I think the biggest change that you're seeing in our market here is the houses that are, you know, what I consider more traditional houses, meaning that they're in areas that are not sought after, but they're not bad neighborhoods. They're houses maybe that have a little age on them. They're normal houses. You know, they're in good shape. They're in areas that people would be comfortable living in, but a lot of times they're not dramatically updated with more state-of-the-art, whether it's cosmetic features or technological features. And consequently, when buyers evaluate these properties, they're factoring in what would they need to spend out of pocket to bring that house up to what their tastes and budget allow. And a lot of times these particular sellers are pricing the homes a little unrealistically because they're pricing them like things were a few years ago, and the market is just not that way anymore. So these are some of the things that people need to factor in when they're pricing properties. And then we have a lot of climactic changes. You know, the wildfires in the California area. We have tornadoes in the Midwest. In Florida, we have increased threats from the hurricanes over the past few years. All these things have made these big decisions a little bit more challenging for folks. And so the affordability index for consumers has changed a lot. And so you're seeing a greater divide between the haves and the have-nots. So one of the things that Forbes has mentioned is, do we feel that we're in a housing bubble that's primed to pop, as what happened in 2008 to 2009? However, both Forbes and myself feel that remains low, the probability of that happening. And that's because the lending guidelines tightened up quite a bit in 2012 due to a lot of the regulatory change that the Obama administration implemented. For example, the lending guidelines previously, leading up to the bubble in 2008 and 9, to be gracious about it, were extremely lax, and they were worse than that. So there was many unqualified purchasers that were getting mortgages that never should have. And so when you combined unqualified purchasers along with property values starting to drop because they were inflated, the combination of that kind of created reverse synergy in the sense that it accelerated the bubble and property values dropped even further because you had these unqualified buyers who were losing equity, and many times they had these gimmicky mortgages that automatically would refinance in a year or two. So they were in negative equity positions. So that accelerated the short sales and the foreclosures, and it was just a horrible time. So when Obama got into the administration, he changed the financing guidelines around 2012 to tighten them up quite a bit to make sure that pretty much just qualified purchasers were qualifying for mortgages. And so that accounted pretty much for the appreciation of real estate from 2012 really through about mid-2023. So we had about a 12-year period of excellent appreciation. Some years were obviously greater than others, but it was a very positive time frame. Starting in around mid-2023 to the present time, the values of appreciation declined dramatically. In Florida, they didn't go down, but they were modestly appreciating. And now, as you know from the forecast I gave you before, they're supposed to be a lot flatter in 2025. So you always have to have control mechanisms. But I mention this to kind of correlate a principle. Some of you may have heard of the term of synergy. Well, what does synergy mean? Well, that means, let's say you had a couple of positive events that were done on their own. Let's say they were spread out over time. So they would have a certain positive result from them. But let's just say you put these positive events in play at the same time and they happen to benefit each other. So the net increase of these positive effects created a synergistic effect, which meant that they improved or increased at a far greater rate than if they were implemented individually. And obviously that's a great thing when you're putting these changes into effect, whether to benefit your business, whether it's to benefit our United States, whether it's to benefit the economy, whatever the case may be. So I mention that because I'm going to use a term called reverse synergy now. And what am I correlating that to? Well, you probably know, if you've listened to any motivational speakers or you've read self-help books or whatever the case may be, that you can look at things with the glass half full or the glass half empty. Obviously, the glass half filled is more of a positive outlook. You try to look at the benefits of something rather than the negatives, where a glass half empty is the reverse of that, and you're focusing more on the negatives. And that can also be a self-fulfilling prophecy. Well, right now, in my opinion, we have something similar to that, and I'll kind of give you my Kaiser logic on that, and that is the tariffs. You've probably heard a lot in the news the last couple of days especially about the auto industry tariffs, and they're supposed to go up about 25% based on what the Trump administration has indicated. And they're going to be phased in, from what I've been told, in two timelines. The first timeline is going to be basically the next week. They said the first week of April, they're going to have the first phase of these auto tariffs. And then starting in the first part of May, they're going to have the second phase of those. So what is that expected to do? Well, if the cost of auto goods out of a variety of ways goes up 25%, it's going to increase the cost of new auto acquisition by a significant amount. So what is going to be the end result of that? Well, in all likelihood, automobile purchases in the new sector are going to decrease quite a bit, just because people are not going to be able to afford them, at least in the short term. At the same time, if you're a person needing auto repairs, the cost of the supplies to fix your automobile are also going to go up in many cases. Many of the auto supplies are imported, and many of them go through this complicated supply chain where if you read about it and it's complicated, they go back and forth to the United States and overseas, and they make the same part may go back a few different times. So they're potentially having these tariffs hit a few different times. It's kind of complicated and beyond my pay grade, but I can just tell you from a practical point of view, when these auto parts go up, the cost of repairs on your vehicles are probably going to go up too, because these cost increases have to be passed along to the consumer. So my only advice, if you're thinking of getting your car repaired, is to do it now. Maybe you can avoid some of these price increases, because if the repairs that your car needs, they already have these supplies in stock, maybe they won't raise the prices until they start getting to the point where they have to reorder stuff, and then for the new batch of supplies, the prices are going to go up. And last but not least, when it comes to the automobile industry, used cars are going to go up, because if you remember from the COVID supply chain problems that we had, there was time periods like in 2021 and 22 where the prices of used cars went way up. Kind of crazy. In fact, I traded in a car in late 2022. It was a car that I had owned for about 3.5 years. It was a car with normal mileage and good condition. And when I traded it in, I got $300 less for it than when I bought the car new. That was crazy, and obviously I was thrilled by it. But that was kind of what I thought was a once-in-a-lifetime occurrence. Well, now with these tariffs and supply chain issues, the new car prices are going to go up also. How much they go up, I guess we'll have to keep our eye on. I'm not even going to try to predict that, other than to say that I know that used car prices will be going up. So how does that correlate to the term that I use, reverse synergy? Well, I probably haven't made this public before, but I always tell people, whether it's family and relatives, especially when you have teenagers as your children, cars are important to them. They would love to have new cars. A lot of people want to drive sportier cars, etc. Well, the thing that I try to teach my kids is that cars should be, number one, a means to get from point A to point B. If you live in Florida, pretty much in all sectors of Florida, our public transportation system is not very good. So if you want to get around in a reasonably timely manner, you need a vehicle. So whether it's getting back and forth to work, whether it's transporting your family to extracurricular activities or whatever, you need a vehicle. Secondly, if you're buying a vehicle and money's not an object for you, then obviously you can afford to get a car because you like its comfort, you like its looks, and you want to enjoy the car. But what can't be argued about is when you buy a new car, as soon as you drive it off the lot, it depreciates. So what does that mean? Well, cars from a financial point of view are a bad investment. For example, if you buy a car, and let's say, I'll just take an average price new car now, somewhere in the $20,000 to $30,000 range, and you trade it in after 3 or 4 years, it's probably declined in value about 50%. So that's pretty significant. So if you were buying that car from an investment point of view, that's a money loser. So you wouldn't want to buy it from an investment point of view. You should be buying it, number one, as I mentioned, to transport yourself. And then number two, if you have the money that you don't need to worry about losing money, then you can buy it for comfort or enjoyment and not worrying about the financial aspect. But why is this the reverse synergy or an opportunity? Because if you're taking my advice to heart, maybe you're going to hold off on a car purchase, especially knowing that car values are going to go up, and keep that vehicle of yours until it conks out, basically. And maybe, especially if you're a customer that hasn't owned a home yet, and you want to get off that rental treadwheel that I've mentioned on many occasions, you take that money that you're saving by not buying a car and putting it into real estate. Because even though real estate, let's say for the short term, is not going to go up a tremendous amount in value, you're accomplishing a few objectives. Number one, you're getting off that rental treadmill. As you know, the rents have gone up and up and up, and people are increasingly having a difficult time affording rent in an area that they feel comfortable living in. And you're paying rent and you have nothing to show for it. You don't have a foothold, you don't have an investment, and your family has some uncertainty. Well, what do I mean by that? Well, if you're a tenant, you have no control over how often and how much a landlord increases your rent. Typically, a long-term rental lease is only for a year, so the landlords can raise your rent each time you're up for renewal. And there really is no rent control in Central Florida, especially on housing. So pretty much landlords can raise rent significantly, and you're kind of at their mercy. And secondly, let's say you're like a lot of tenants and you move for whether the house becomes less affordable for you or whether the landlord has a change in circumstances. And let's say the landlord wants to sell the house and gives you notice. Well, now you're forced to move. And the landlords have a lot of reasons for that. Maybe they want to reallocate their equity. Maybe they want to get out of the long-term investment vehicle. Maybe they want to buy a resort property at a vacation destination. Maybe they're empty nesters and want to downsize. Maybe they want to relocate to a different part of the country that's more affordable. Maybe they want to be near relatives. There's a lot of reasons why a landlord may decide to sell. Or maybe they just want to maximize their profit and feel it's a great time to cash in. So there's a variety of reasons for that. And just to give you some financial analysis, I'll give you a very simplistic example. We have something that's called the Rule of 72. And so what that means is, let's say you had the benefit of these 10 or 12 years of growth. And let's say that property values increased on average during those 10 to 12 years. Let's say they increased 6% a year. So you doubled your value of your home in 12 years. So to give you a numerical example, let's say you bought a house in 2012 for $250,000. And let's say you sold the house in 2024, and we'll be conservative. Let's say you sold it for $500,000. Many houses would sell for more than that were bought at $250,000 in 2012. So you doubled your money and you owned that house for 12 years. So you had a 6% increase. And let's say in 2012 you were a first-time buyer and you only put $25,000 down, which is 10%. So that $25,000 actually made you $250,000. So that's somewhat called the concept of leveraging. So you made 10 times on that $25,000 of liquidity. Where if you bought a stock in the stock market in 2012 for $25,000, in order for you to equal that real estate investment, your stock would have had to increase tenfold or $250,000. Well, it's very unlikely in most cases, even if you have a great stockbroker or you're a very good investor in stock market, that you're going to come anywhere near that increase in value. So the point of leveraging and those rules are, real estate is probably and continues to be the safest investment and the greatest vehicle to not only financial stability, but financially making your family and your lifestyle more comfortable. And that never changes. Real estate is still probably the most consistent and a risk-free long-term investment. It always has been, and it always should be, unless, again, something dramatically changes in how the United States functions as an entity. So those are some things to think about, but I would give long and hard thought to that, because let's take the negative of the cost of autos increasing dramatically, and let's reallocate that money that you were planning on putting into an auto and putting it into a house and creating that financial stability for you and your family and the continuity so your kids can grow up in the same house. You can position them in a school system that you're comfortable with. Maybe they're near your friends and family, whatever the case may be. But once you're a homeowner, you move because you want to, not because the landlord forced you to. And that's how you get roots in a particular area. And it's so important. And the other hidden benefit of that is if you're buying your principal residence for you and your family to live, and I gave you that example, if you paid $250 for the house and you sold it for $500 and you lived in the house for more than 2 years, there is no taxes on that. So that's tax-free gain for you. So it's a win-win-win situation. So give some thought to that, because that would be a way to take a big negative into a big positive for you. I probably got your head spinning a little bit with this finances, but I hope it's helped, because you need to look at facts. And in order to make an educated decision and increase your family's financial position, you may be the kind of person that can do this on your own, or you may want some assistance. Well, if you went to a doctor, you'd want to get an expert in the field. And if you're looking to consider investing in real estate, you need to get an expert in the field. So you need to get somebody that not only has the experience and the insight, can give you correct factual data, can give you recommendations on how to get the best bang for your buck. And so you need to call an experienced and skilled real estate professional. If you'd like to call someone, I'd always love to talk to you. Again, this is Marty Kaiser. You can reach me at 407-595-9700, and I'd love to talk with you. There's no cost or obligation. Last but not least, we'll give a little 30-second briefly on sports. For those of you that are sports fans, we're in the midst of the NCAA basketball tournament. If you heard my last couple podcasts before the tournament started, I mentioned 3 teams that I thought one of them were going to be the champions. I mentioned the Florida Gators, the Duke Blue Devils, and the Auburn Tigers. Last week when I came on after the initial games had just started, I decreased my choices to 2, the Florida Gators and the Duke Blue Devils. Right now, we had the first games last night of the last 16 teams. So after this weekend ends, we'll be down to 4 teams. We have a set of games today, which will decrease us to 8 teams. And then this weekend, Saturday and Sunday, it'll decrease us to our final 4. And so the final 4, I still predict the champion will be between Florida and Duke. They both played last night and won impressively. I'm withholding my final prediction of which of those 2 teams is going to win until I analyze the conclusion of these games and who they play in the final 4. So anyway, that's all there is for now. I hope everyone is doing well. Feel free to call with more questions or concerns. Let your friends know about this podcast. Have a great weekend, and this is Marty Kaiser out.